Hey Joe, the market is at all-time highs. Do you ever think about taking some gains off the table? Great question today. I also got two more things to talk about. Number one, I got an exciting announcement regarding health insurance at the end. I'll leave a timestamp for that. And also, I'm adding a new feature, hopefully, to all my videos going forward, where I have recommended actions for you to take. So I'll talk a lot and then I'll say, hey, here's some things that I really think you should be doing and feel good about. So I'll be very specific about those actions to take. So back to taking stock market gains off the table, taking a percentage of those, maybe reducing some risk. My growth bucket is 2x, twice what it was when I retired 6.5 years ago. So if I was able to retire on a lesser value, now inflation has, caused me to need a little bit more, but it's 2x. Should I cut down some of those gains? A lot of headwinds, looking at us, here in 2025. Is there a stock market crash coming from overvaluations, in the U.S., particularly the Magnificent Seven? You think of Amazon and Meta, and Nvidia, Google. Man, those things they're overvalued. And here's press release, there will be a correction, most likely in a 20% plus reduction, making it a bear market. Also, a lot of content out there on YouTube and, in the space of retirement. Is there going to be a crash coming from deficit spending, the national debt? Again, I'll say yes. But for both of these, how long is that going to last and how big is it going to be? I hear people talking about the AI revolution, robotics, blockchain. Is it overhyped? I have equal videos that I listen to that says it's underhyped, and innovation is really going to be dramatic, changing a lot of jobs. And then inflation. What's inflation going to do? Most people don't realize, and you do when you're in retirement, that inflation is that silent little killer eating away at your nest egg and your spending every single year. It is harder to plan for, in my opinion, than a stock market correction. The stock market goes down 30%, comes back 2 years later. You can plan for that. You can have some fixed assets that you live off of. You can rebalance, you can use buckets, whatever. But inflation is at 9% one year. You've just increased your spending for the 30 full years of your retirement. It doesn't go back, which deflation would have to occur to have it go back. And it rarely occurs. It does, but it's rarely happens. So, looking at, how do I analyze this? Well, I go to YouTube and I listen to professionals. And I don't include myself in that professional list. I'm a retired person taking action based on a lot of inputs. So I just listened to this guy this week that said you should be in 100% stocks and just have guardrails on your spending. So it doesn't follow the 4% rule, but somewhere around 4%. And then if the stock market goes down 20%, just reduce your spending, to what you need. And don't have some of the frivolous spending on travel and new cars. Just delay that. You do that. 100% stocks has a pretty good track record. Okay. The next video talks about how you need to be 60-40 and you need 40% in a tips ladder. And that tips ladder is, basically fixed and it's adjusted for inflation. So you don't have any worry for the next 10, 20 years because you got it in a tips ladder. I get a lot of comments on my content saying, Joe, you're insane. You have 10 years of expenses in your bucket one that are in fixed. That's way too much. And I get equal comments that say that's way too little. And where do you go? It's kind of a minefield that we're walking through. Annuities are another hot topic that is out there. Should I lock in higher payments? You can get, last time I looked, and it's been a few months, you can get like a 7% payout, 6-7% payout. But most often those aren't adjusted for inflation. And if the ones I saw, if they are adjusted for inflation, it's like 2% a year, and it dramatically reduces your payout. But 2% a year inflation doesn't really bother me. It's the 3, 4, 5, 6 that is really catastrophic to a retirement plan. So is it now time to buy annuities? There's just all this information out there. Driving a lot of fear and a lot of, not fear based on a lot of truth, but what action to take. My situation, you guys know I have buckets. I now describe my bucket situation as I just have two. I've got a fixed bucket and a growth bucket. I used to have three, and that's when interest rates were very low. Returns on fixed was very low, that I had some money in a bucket too that was in a 60-40 fund, think like Wellington. But now I just have two buckets, okay? I've got 83% of my money in equities, okay? Think international, I got 17% of my 83%, not to confuse you, but 17% of my equity exposure is in international, which has been doing great so far this year, not overvalued like US stock market is. But overall, I'm 83-17. 17% is the fixed. I also have income coming in for 4 more years, 3 more years of deferred compensation. This is compensation I didn't take when I was working. It's kind of like a separate 401k. And what I love about it is it starts paying upon my retirement. So I was 54, so it starts paying immediately for 10 years. I have a $16,000 a year pension. I do make some money from YouTube, and I make $500 from a book I wrote, $500 a year, roughly, on reliability and maintenance. Not too many people enjoy that content. And I do make some money from affiliates. So the 10 years that I have of expenses in bucket one is net of all those incomes. It's expenses that I need to cover from my investments, okay? So my fix is in a money market fund, mostly in a bond fund. I guess it's about 50-50 in both of those, money market fund and bond fund. My equities, all mutual funds. I don't have any individual stocks. 17% international, as I said earlier. My expenses are pretty high this year. I had 2 weddings, actually 1 wedding so far. I got another wedding coming up of a child in October, and we're contributing a fixed amount to that. And we just wrote a check for some new flooring. My house, we had a dog. I have some wood floors. We're going to get all that refinished, get new carpet, and some laminate floor down in my basement. This is one of the drawbacks of having a big house, but raising 4 kids, a couple dogs, and it's time to just level set everything. I guess that is kind of taking some gains off the table. It's taking advantage of the stock market being high and taking out one of these one-time expenses is smart to do when the market's high. So bottom line, based on history, and I study history a lot. I've made a lot of videos on the history of bear markets. I believe I'm well prepared for the next bear market in both fixed and my equity holdings. My fixed, I'm prepared for, like I said, 10 years. And my equity holdings, like I said, my equity is 2x what it was when I retired. So yes, I was lucky to retire when I did. Who knows the future? Also, I can crank down on my expenses pretty easily and get about a 2% burn rate. This is just basic living, just paying my bills. This is not going to Europe or, extensive vacations, paying for a couple weddings or anything like that, but I can get down to 2%. So, here's what, people are looking for a formula, like to put guardrails on their spending, 4%, and then have guardrails if the market's up or down. That's going to come natural. You'll spend more money when the market is good. You'll spend less money when the market is down. When the market's down 30%, I'm telling you, nobody needs to tell you to cut spending. It's going to happen automatically. Um, Also, I do have, some people may look at my exposure, 83%, 17% equity to fixed, and say, that's pretty high, but yeah, maybe it fits me with my low burn rate. Um, and also, you need equities to attack inflation. I talked about that earlier. Inflation is the real silent killer. You can plan for bear markets, sequence of return risk, and there's things you can do. But inflation, you need to have something that grows beyond it. And equities is really the only solution. When you look past like 10 years, um, bonds, get chewed up by inflation. Okay. And the better investment countermeasure is really equities, my opinion. Okay. So that's what I'm doing, decisions I'm making. So a couple, rather three, take actions. Okay. One, are you prepared for the next bear market? It's going to happen. Okay. I'm telling you, I'm going to tell you the future. It's going to happen. Model a 50% drop for the next 4 years. You're down 50% and it recovers after 4 years. Don't just look at the bear market. You got to look at the recovery time. Okay. If the bear market is, 2, 3 years, and then the recovery is 1, 2 years, that whole cycle is what you've got to model. Okay. Model 50% drop. Don't just rely on luck. Know your weak points and what levers you have. Okay. Number two, if you think you are good, okay, you think your plan is good, hey, I'm rock solid. Is that only in your own head? Are you the only judge on whether your plan is good? I don't like that at all. Okay. I don't think that is wise at all. You have blind spots, you have errors, mistakes inside of your thinking. Okay. If you have questions all about your plan around inflation, can you handle a 50% reduction? Why don't you run that by somebody else for free? Okay. For free. The folks at Money Pickle, they're like the second link below. Free 45-minute phone call that you can have on your terms. Okay. So when you fill out this, you hit that link, take you to a calendar. What topic do you want to talk about? You can talk about inflation. You can talk about, am I prepared for a 50% market drop? And then you share in that call your whole financial situation and get a CFP to kind of put a stamp on what you're thinking. Okay. Sales pitch, maybe in the last 5 minutes, but they are committed. They're committed to answering your questions. Okay. So hit that link, run your plan by a professional. Okay. Action number three. Are you prepared for periods of high inflation in your plan? So go into your plan and select, 4% inflation, 4.5% inflation. See if that makes your plan fail, and then see how you can solve it. Okay. Can you what spending do you, may have to reduce? Do you have to change your exposure inside your stocks? See what your Monte Carlo score does when you have periods of high inflation. A plan is not static. It's not something you create when the day you retire and then you're just implementing that plan for the next 60 years. No, it's a snapshot in time, and it helps you understand the levers that you have with the current state. So I execute my plan every 6 months. Every 6 months, I'm going in and I'm updating my plan with the current valuations I have and the current concerns I have around inflation and returns, things like that. So last thing, if you made it this far, this is on health insurance. I'm working with a health insurance provider that specializes, I never thought I'd find this, specializes in early retirees. Their focus, their main business is, well, actually, that's their whole business, is early retirees. They currently only work with certified financial planners. So they work with them in all 50 states. When people go in their office and say, hey, I don't have anything worked out on health insurance, they send them to this company, and so they have a partnership. Their only source is certified financial planners. Don't do any advertisement. Don't do anything working with the general public. But I got in contact with one of the executives there, and they are very interested in expanding through YouTube, through my channel as a test. And no fee at all to you. No fee at all. You'll work with an agent to review your financials to see maybe is the ACA with the credits appropriate for you? What can you do? They'll guide you to the right policy, whether that's private insurance, whether it's ACA, and whether it's a health shares, that Christian health share plan. They are in this business. They deal with pre-retirees and early retirees exclusively. So when you pick up the phone and call one of these individuals, you're going to get somebody that knows exactly what you're going for. Not registered. They are registered in all 50 states. This is not ready for you yet. You can see there's no link for that down. If you look, they have to modify their website. We have a handshake agreement on this right now. They're going to modify their website. How are they going to take viewers from my channel and funnel them into their agents? How are they going to train their agents? So they're going to train them. Yeah. So look for this in about mid-September. I think it's going to be great. Right now, if you go on the internet and you look at health insurance and you type in your information, you're going to get inundated with phone calls. And they handle clients from 20 years old to 80 years old. This firm only works with those that are pre-Medicare retirees. That's all they work with. And they're wanting to partner with me as a test to see if this could help them grow their business, or is it something they don't want to get into. So I'm excited about it. We'll see. Look for that in forthcoming videos. Jot it down on your calendar to look up one of my videos on around the middle of September, and may just have a nice video on that. This is Joe out.